I originally made a video speaking on this already, but it got corrupted, so I'm gonna do this again. So this video is basically just on contracts and how they can make you money. So, just predicting the price of where you think a stock will go, and it does make you like quite amount of profit on the premium. So the site I'm using is Robinhood right here. Um, I will try to do a mobile perspective, um, but for now I'm gonna use the desktop. So right here you can see investing, not looking so well, but it's okay. I'll come back. And then right here on the right side you can see like all the names, the ticker symbols. So typically what I do to like make money like from contracts, the most popular one to use is SPY because it's so versatile. And SPY is just basically like the whole market. It's the whole um, it's like every stock, or SPY like has like very popular names, and so if like one big name goes up, then mostly the other ones will go with it. It's very good to trade on SPY, but you can also lose money quickly, so it goes both ways. All right, so first let me explain what is on our screen right here. Right here is the strike price. This is the price that we think the stock right here will go to. So right now the stock is at $597. If we think by right here the expiration date, which is when a contract will expire, once the expiration date, like by the end of the day for an expiration date, so if it's a 0-day contract and you don't close the contract before the end of the day, it will basically become worthless. You can't trade on that contract anymore. But it's the most popular contracts to do, 0-day expiration contracts. You just buy them and then you sell them same day, like just like that. I'll get into that in a minute though. So here's a strike price. We're just saying what price we think the stock will go. And so you must be saying like, what does that mean? Like, what do you mean by that? So on contracts, you're basically buying, or you're borrowing 100 shares of that stock, and you're using that as leverage for insurance, and you're predicting the value the stock will go. So it can either be like going up or going down. You can assume if it's going up or down. You can make insurance off either the stock going up or down. As I said, I think I said that like 3 times. But right here there's 2 options. There's calls and puts. Now calls is when the thing or the stock goes up, and puts is when you think the stock will go down. So right here you see that 598, 599, 600, that's where people think that the stock will go by 2 days, and they have a set price value right here. I'll just do an example on calls. So the closer the stock is to the strike price, the more valuable that contract becomes. So right here it may show $2.78, but that's not really the case. The real case is because that we're borrowing 100 shares, we must multiply this number right here, 278, by 100. That is your actual price. This is not $2.78. I wish it was, but it isn't. The actual price is $278. So right here, oh, it refreshed, okay. It shows you, Robinhood will tell you the price. So the estimated cost is $278. Now, you can buy more than one contract, and of course that will cost you more, but the more contracts you have, of course, like if it goes up from 278 to 300, then you will reap the rewards on 2 contracts, right? So the more you gain, the better. Right here, there is a bid and ask price. Of course, if you don't want to buy at the asking price, you can try bidding for a lower price. It might work, it may not. It really depends on the person who is selling the contract, right? Or how much you're willing to buy this contract for. Okay, right here, the Greeks, these are just statistics telling you either, hold up, I have them right. So the theta, right here, it's the time it decays. So a contract, right here is 278. This is 0.81. So every time it has like or negative 0.8. That's like how much it will lose. So you just go to the next decimal point right here. It will lose 1 cent every day, or that's what it shows right here on my notes. But you may lose more because this is like 81, so it may lose even more money. Also on contracts, typically if you want to do like not like a risky trade or anything like that, you can try buying the contracts way like later down the line. So for this one, this is like 2 years out, right? And these contracts, they're not going to decay as much as the contracts as today or tomorrow, just because like they're so far off, and so people aren't really like worried about those. But they do come at a price. They come at like this one's $9,200. So the more time, the more valuable the contract becomes, because time equals money. That's just how it is in the market. Sorry if you can hear that in the background. But yeah, that's not where you really want to make money. Like short term, long term, I think it's a great place to put your money in, especially for SPY. Like in 2 years, you don't think SPY is gonna increase by 597. It's highly likely, especially in 2 years. But I'm not really here to give you financial advice. Oh shoot, I should have said that in the beginning. I'll do that later. Okay. So that's the theta is time of expiration, how much it loses value per contract. The gamma will rise. So like if it's 0.10, it will rise like 10 cents, which is equivalent to $10. So the more gamma, the more valuable the contract becomes. And then the delta kind of follows the same thing as the gamma. It's just a tracker. I think the gamma is a tracker for the delta, which tells you if it will increase the asking or the price itself of the contract. I may be wrong, so I don't really pay attention much to the Greeks, but that's what that is. But yeah, so calls basically assumption of the price going up of the stock, and then puts are literally the opposite. So, oh shoot, I forgot to do one more thing. So yeah, if the strike price is in the money, this is what we call in the money, when this line right here is inside. So this has already been hit, right? So it's going to be worth more. The more the share price goes up, the more the strike prices will go in the money, right? Meaning more valuable. The same thing goes for puts. So right here, this is $600. So if it goes down and down and down, more and more and more, the in the money contracts right here, the more down it goes, the better, because you're making more money off these contracts. And then it's the opposite for calls. Up it goes, more money. Puts down, less money. Or yeah, calls go up, puts go down. Bull is call and bear is puts. You may see the builder and the sell. I wouldn't recommend touching those quite yet. I would try just like learning terms first, like bull, like bear, or like other things like value gaps on charts and perfect charting. You want to keep looking at the charts. They do tell stories, because they can tell you the valuation of the stock itself, and also you want to go off news. Those two things are very important when you are trading contracts for like 0-day expiration, because you don't want to just buy a contract and just be in the unknown. That's not really smart. So I would recommend looking at the news. And if you might be saying like, oh, I don't know who to listen to, or I don't really know that, well, there's this YouTube channel called like it's like a Mitt, right? Okay, well, he looks kind of goofy, but he'll do live streams on the market, and like he'll just give you a rundown on like the stock and then like what the market's doing, so you have insight already of someone telling you like, okay, this is what's gonna happen. This is like kind of like, oh, like bearish, bullish, like if it's good or bad, right? So and then from there you can do your assumption, your DD, and you could be like, okay, I think the market's gonna go green, or I'm gonna think the market's gonna go red. So from there you can do calls or puts. I typically do that, and he gives me like information very well, very accurately. But that's basically it for calls and puts. I will go into builder and sell later. I would not recommend sell. This is like if you're selling a contract. Remember, a contract is worth 100 stocks. borrowing. If you're selling 100 stocks that you do not own, you will be in debt. So please, please, please do not do this. Just don't touch it. All right, as easy as that. Builder will do cover calls and like debit spreads, all that later. But for now, just stick to calls and puts. I think it's great practice for now. Although I do think like debit spreads are way more profitable, I think it's great to know the basics. But yeah, that's it for this video. You can trade mostly every stock for contracts. So if you think one specific stock, it doesn't have to be SPY. If you think one specific stock is gonna go up, like I don't know, Google or Robinhood or HIMS. HIMS is very versatile. I wouldn't say DGT. Grab. No, I wouldn't really put money in Grab. I mean, I think it's a great stock. Oh, Palantir. Palantir is a great one, especially now with like all the war. That's terrible. I know it's terrible, but yeah, that I guess that's one way to go about it. You can put your money in something that's happening. Again, remember everything's news driven, so yeah. But yeah, I think the only ones that don't do contracts are like privated companies, of course, and I think Nintendo don't do contracts, which was crazy. I found this out like a couple of like weeks ago. Yeah, Nintendo's don't do contracts. They sell their stock, but they don't do contracts, which is just wild. I think that's wild. But yeah, that will be it for this video. Thank you so much for watching. If there was something I didn't make clear, please put it in the comment section so I can try to find a way to make you understand. And I will do run up videos. I think I'm gonna do a video where I'm just gonna like trade with $100 and see how much that can get me in the market. Because I mean, I've done so well, and I did so well, and then it would crash down. But that shit don't stop me. You know, it's whatever. But yeah, thank you so much. Have a nice day and have a nice life. I did forget to add that this is not like financial advice. If you do this, this is on your own accord. Also, with contracts, they do expire. Like 0-day expiration contracts expire in a day. When I would say like the best time to pull out of a contract is like when at least you made like maybe 10% of what you put in. So then like you at least come out with a profit. Also, selling a contract, so when you buy it, it will tell you you have the order. Then you come back to the home screen, like come back to the like the main web page. Right here on the right, it should say like your position of your contract. You just press on it. I don't have an example right now, but you just press on it and it will show you your contract. And as the example of like when you put when you buy the contract, let me go here to options. When you buy the contract, you'll like put one contract and like what price you want to buy it at, right? So 274. I don't have the money, but just say 274, right? You buy at this price. You'll have the same exact thing in the in like the menu. You just press on the contract and it'll show you this. It'll show you like this right thing. You just select the price that you want to like sell your contract for. So this is 278. Made like, imagine you made like $22 more. So it'd be like $3, right? So you put 3 and then you could do review and then you could sell. You can like have a pre-estimate sell. It doesn't have to be like necessarily like it has to hit the number right now. So if you think the contract's gonna be worth $20 more in like an hour or 20 minutes, you can put at a preemptive like order. So then once it does get to that price, it automatically fills for you. So then you don't have to worry about it anymore. I did forget to add that. But yeah, that's it.